Whether you're self-employed or an employee, a health savings account or HSA can have a triple tax benefit. You can receive tax deductions based on the money put into the account, tax-deferred growth on any interest earned on the investments inside the account, and potentially tax-free distributions from the account that you take for qualified medical expenses. The HSA is the only tax-advantaged account that has the ability to give you both a tax deduction for the money you put in and tax-free withdrawals on the way out, even better than the Roth IRA. Not to mention, you can invest the money inside an HSA in a wide variety of investments. In some people's opinion, it is seen as the ultimate retirement savings vehicle. So don't let the name fool you. Hello and welcome to the Retired-ish podcast. I'm your host, as always, Cameron Valadez, certified financial planner and enrolled agent. Here today to help educate you on the benefits and rules of the health savings account, or HSA for short. This is one of my favorite topics to discuss. I absolutely love HSAs and the potential benefits that they can provide. In my opinion, they are truly one of the best savings vehicles available to build wealth efficiently and save taxes throughout your lifetime. Some personal finance academics estimate that an average retired couple at age 65 will need at least $300,000 to cover health expenses throughout retirement. Some will require even more. This is in line with the Fidelity Retiree Healthcare Cost Estimate, which states that a single person age 65 in 2023 may need approximately $157,500 saved after tax to cover healthcare expenses in retirement. An average retired couple age 65 in 2023 may need approximately $315,000 saved, some less, some more. The key word here is after-tax money. Ultimately, how much you will want to save for healthcare costs in retirement depends on your health and longevity. When you incur major medical costs, what type of insurance coverage you buy, as well as the type of vehicle you use to save for those medical expenses. This is where the HSA comes into play. What exactly is an HSA? An HSA is a special type of account you can utilize to help save for medical expenses you might incur throughout your life, and it has numerous tax advantages. You might be thinking, well, then what is health insurance for? Well, as I'm sure you know, most health insurance coverage doesn't cover literally everything, and you're likely to still have some out-of-pocket healthcare expenses from time to time. Sometimes a little, sometimes a lot. Healthcare is expensive, especially as you age into your later years, and the HSA basically provides us with a tax-advantaged way to save and help pay for those expenses, and potentially build significant wealth along the way. By saving into an HSA, you can potentially eliminate the after-tax savings issue I just mentioned. By using an HSA properly, you might get away with saving less dollars and still being able to cover a majority of your qualified healthcare expenses in retirement, or even your spouse's qualified medical expenses. Without the tax benefits of the HSA, you will have to save more of your income or rely on superb investment performance in order to be able to have the same buying power as an HSA, since you will have to pay taxes on the money taken out of most other investment vehicles, or you pay taxes as you go. So let's summarize the triple tax benefits of using an HSA. The first is that you receive a federal and possible state tax deduction for the amount you contribute into the account up to an annual limit. And the cool thing about this is that you can get this tax deduction no matter what your income level is and no matter what you spent on actual healthcare costs. This is crucial since many people see no tax benefit or write-off for out-of-pocket healthcare costs. In order to get any sort of benefit, your income has to be on the low side, while your healthcare costs need to be on the high side. With an HSA, none of that matters. You get a tax deduction simply by putting money into the account each year up to the annual limits, even if you didn't spend any money on healthcare. When it comes to tax write-offs, this is low-hanging fruit. Now, I want to take a quick moment to caveat the fact that depending on the state in which you live, you may not get a deduction on your state tax return for making these contributions. Specifically, I'm talking to my California and New Jersey peeps. If you live in these states, not really a surprise here, but unfortunately, they do not allow a deduction for HSA contributions. However, you can still benefit from the federal deduction and some other benefits we'll get into later, so don't push it to the side just yet. The second benefit HSAs provide is what we call tax-deferred growth. When you have an HSA, you can just have the money sit in cash after you contribute it to the account, or you can invest it in a wide variety of things. You can even have some money invested and some in cash. Regardless of what you do or how you invest, when you make money on those investments while inside the HSA, you don't pay any federal taxes on that money in any given year. Any earnings continue to sit in the account and have the ability to keep compounding over time if you choose to reinvest. Over the long run, tax deferral can be an extremely powerful wealth building tool. Notice how I said federal income tax. Again, don't hunt the messenger, but California and New Jersey also don't abide by this rule. Shocker, I know. And any earnings or gains inside an HSA will actually be subject to tax each year at the state level in those two states. But again, don't fret. Even if you're in California or New Jersey, your taxable income might just be low enough to put you in a low state tax bracket. So it's not always the case that you will be paying a boatload of taxes on any potential earnings each year. And again, you still get to defer federal taxes, which are higher for most. All right, 2 down, 1 more awesome tax benefit to go. Isn't this just awesome? The third major benefit, and my favorite benefit by far, is the ability to get money out of the HSA tax-free. You can take tax-free distributions from your HSA if you take the money out to pay for what are called qualified medical expenses for you, your spouse, or any dependents you might have, and you can do this at any age. You don't need to be in retirement. Qualified medical expenses are those that are listed in what is called IRS Publication 502, which is public information, but to make it easy on you, I will put a link to it in the episode show notes for today's episode. Or instead of using the HSA money directly to pay for those medical expenses, you can actually reimburse yourself back for older medical expenses you might have paid out of pocket at some point in a previous year from, say, your bank account. More on that strategy later. This means that you could see all 3 tax benefits if you use the money in the HSA for qualified medical expenses. No other investment vehicle can give you this opportunity. I will get to what happens if you don't use the money for qualified health expenses in a little bit. So now we know the major benefits of the HSA and why these accounts can be so powerful. But there's got to be some sort of drawback or rules that go along with it, right? And the answer is maybe. It depends on your situation and your goals, quite frankly. But let's go through them. The first and most important thing to know is that there is essentially one major requirement you need to meet in order to even be eligible to put money into an HSA. And that is that you or your spouse must be enrolled in what is called a high deductible health plan, or HDHP for short. A high deductible health plan is a special type of health insurance plan that must have a minimum annual deductible and a certain maximum out-of-pocket expense limit. These are limits set by the government, essentially, and they usually adjust each year. The minimum deductible and the max out-of-pocket required will also be determined by whether or not you have a plan that offers only individual coverage for yourself or family coverage for you and maybe a spouse and some dependents, which I will elaborate more on in a minute. For instance, in 2024, the minimum deductible for individual coverage is $1,600 a year, and the out-of-pocket max is $8,050 a year. The family minimum deductible is $3,200 a year, and the max out-of-pocket on these family plans is $16,100 a year. The good news is that just about anyone can get these high deductible plans, either from the federal health insurance marketplace or your state's health insurance marketplace if they have their own, and they are usually an option provided if your employer offers you a menu of health insurance options. Most of the high deductible plans meet the deductible and max out-of-pocket guidelines for HSA eligibility, but always double check each year just in case. I also want you to know that although there is a minimum deductible and maximum out-of-pocket amount, many plans will have their own dollar figures somewhere within those guidelines. This is where you really need to determine if a high deductible health plan makes sense for you in the first place. If you're going to have a really high deductible, you'll of course want to make sure that you either already have an established emergency fund to cover that deductible should something happen before you start saving into the HSA. And two, you generally want to be a pretty healthy person. If instead you have incredibly high and frequent medical expenses, you may want different healthcare coverage, and therefore an HSA may not be right for you. And just to clear this up a little bit, because I get asked this question all the time, the health insurance plan itself is separate from the HSA. You get the health insurance plan, the high deductible plan, and then once you have it, as long as it meets the HSA requirements, you get to go open an HSA account somewhere else. The HSA is not offered with your high deductible health plan, or if you're signing up for one of these plans through your employer, it's not like the employer is going to be necessarily offering that HSA. You might have to go open it somewhere else. So if you choose to enroll in one of these high deductible health plans, you're generally set. And now you're eligible to go open an HSA in the year that you enroll. The only caveat to this where you wouldn't be allowed to have an HSA is that if you have coverage from Medicare, Medicaid, TRICARE, a flexible spending account, or you're covered under your spouse's plan that's not HSA eligible, like a typical health insurance plan that's not a high deductible plan that meets the qualifications. You also can't be claimed as a dependent on someone else's tax return. This usually isn't an issue for most people, but sometimes this does crop up. In these cases, you generally can't contribute to an HSA, but there are some unique circumstances when it comes to Medicare, which I will get to a little bit later for our listener question. You see what I did there? I've been saving this question for this particular episode. The next rule you need to be aware of is the annual contribution limits. There's only so much you can put into one of these accounts in any given year. This, again, will depend on whether you have a high deductible health plan that only covers you as an individual or a family plan that covers the entire family. The family limit applies whether or not you have one HSA for just yourself or you have one for yourself and your spouse has their own HSA. Remember, your spouse can have their own account if they'd like, as long as they are covered under a high deductible health plan. If you and your spouse each have your own HSA, you cannot contribute up to the family maximum 2 times. You can't double up. That limit is between the two of you, however you decide to divvy that up between the two accounts. In addition, if you are age 55 and over, you can contribute an extra $1,000 per year for yourself via what is called a catch-up contribution. An important thing to note here is that if you have only one HSA in your name, where you make a family contribution for you and your spouse, for example, even though your spouse may also be over age 55, you cannot contribute that catch-up contribution for them as well. The catch-up contributions are on a per-account basis. So, if you each wanted to make the additional $1,000 contribution, each of you would need a separate HSA since there is no such thing as a joint HSA. The annual contribution limits are generally prorated for each month of the year you are covered by a high deductible health plan. This means that if you only had a qualifying high deductible health plan for part of the year, you generally can only make a partial contribution for the year, not the maximum amount or the annual limit. However, there is an exception. Under what is called the 13-month rule, or some call it the last month rule, you can still contribute the full amount to your HSA, even if you didn't have an HSA eligible plan, health plan, for the entire year, but you have to meet these two conditions. The first, you enroll in an HSA eligible high deductible health plan before December 1st of the given year. And number two, so you have to do both. You maintain that high deductible health plan coverage through December 31st of the following year. So a total of 13 months. Now, why is this important? Because you can fund your HSA at any time during the year. It doesn't have to be necessarily on a monthly basis. And similar to IRAs, you have up to the tax filing deadline in April of the following year to make a contribution for the previous year and get the tax deduction. So what some people will do is they will make that contribution and they might max out the account all at once. Well, if you don't abide by this last month rule and you do the full contribution when you were actually only allowed to do a partial contribution, now you have over contributed and you will need to get the money out timely or you will pay penalties. If you think you will be in a situation like this, or maybe you already are and you've over contributed to your HSA, it's best to reach out to a professional for advice. Okay, where's the potential gotcha with these accounts? They sound way too good to be true. There is one potential hiccup when it comes to HSAs, but only when you do not use the money for qualified healthcare expenses. If you take money out to use for anything other than these types of expenses and you are under age 65, you will pay income taxes and a hefty 20% penalty on the amount that you took out of the account. So you definitely want to avoid that at all costs. But here's a really cool feature of HSAs. Once you reach age 65, you can actually take money out for any reason at all that's not a qualified healthcare expense, and you will only pay the taxes, no penalty. This means at 65, it essentially acts like both a traditional IRA and a Roth IRA combined, depending on what you use the money for. Pretty cool, right? However, there's yet one more cool thing that makes them even better than an IRA at that point, and that is there are no required minimum distributions, or RMDs. Therefore, at your would-be retirement age for a pre-tax retirement account like an IRA or 401k, you won't be forced to pull any money out of your HSA and you can let it continue to grow tax-deferred. Okay, so all that sounds good, but what happens if I saved up a bunch of money in an HSA and I pass away before spending it? How does that work? This will ultimately depend on whether or not you have a listed beneficiary on your HSA and who that beneficiary is. If the beneficiary is your spouse and you pass away, they will become the owner of your HSA, or they can roll it into their own. Nobody is taxed on anything. If the beneficiary is someone other than your spouse and you pass away, the money cannot remain in the HSA and the full amount will be taxed to that beneficiary. The only caveat here is that the beneficiary does have the ability to pay any unpaid medical expenses you may have had before passing within 1 year of your death. This amount would not be taxable. That is actually a planning tip that most people and even most tax professionals have never heard of and can be utilized and save a beneficiary a lot of money. So keep that one in mind. If your trust, on the other hand, is the beneficiary, or you don't name anyone and therefore your estate becomes the beneficiary and you pass away, the funds cannot stay in the HSA and you are actually subject to taxes on the full amount on your final tax return. Kind of quirky, I know, but that's how it goes. There can be some really cool estate and tax planning techniques to utilize here just by adjusting your beneficiaries and knowing these rules. A simple change could potentially save your heirs thousands. And lastly, if you name a charitable organization as your beneficiary and then pass away, the money doesn't get to stay in the HSA. However, they are not taxed on any of it. Even if you're charitably inclined, depending on your situation, it may or may not make sense to make a charity the beneficiary of your HSA funds. There might be some better alternatives with other potential assets that you may own. All right, enough with that. Let's get back to the cool stuff. Here's a couple other rules and opportunities that HSAs have that can also be really beneficial. If you want to jumpstart an HSA, you can actually make what is called a qualified HSA funding distribution. This is a one-time opportunity in your lifetime where you can transfer money from a traditional IRA or Roth IRA retirement account directly to your HSA up to the annual limit. Again, you can only do this once, and you need to be aware of whether or not you're eligible to contribute the maximum amount for the given year. But when done properly, it can really kickstart that HSA. Another cool component to how these accounts work, I actually alluded to earlier, and that is that you can actually distribute money from your HSA and essentially pay yourself back for medical expenses you incurred in the past after you created your HSA. And the distribution will be tax-free to you. This is, of course, if you didn't pay for those medical expenses originally by using funds from your HSA. There is no rule on when you can take distributions or when any particular qualified medical expense was incurred. Just make sure that if you're ever planning on doing this, you will always want to keep accurate records of your medical expenses and how they were paid. In addition, you will want to be sure you didn't ever deduct any of those medical expenses when itemizing on any previous tax returns or any medical insurance premiums you may have deducted on your 1040. So be really careful here not to double dip, and you have to make sure you keep very accurate records, and those records should include your previous tax returns. Therefore, if you paid, let's say, $2,000 for a qualifying medical expense 15 years ago, and you had an HSA back then, and rather than using funds from the HSA, you paid out of pocket using your bank account at the time, and you received no tax deduction for it, you can theoretically reimburse yourself for that expense today, or even another 5 years from now. This cool nuance can allow you to use your HSA strategically to amass wealth over a long period of time if you invest inside of that HSA. Okay, now I'm going to sidestep a little bit, and I'm going to let you in on a pro tip that's very rarely utilized because it's unknown to most individuals and professionals, but it can be very useful if you have adult children or grandchildren. Just to set the stage here first, remember, in case you didn't know, a child can remain on their parents' health insurance until they are 26 years old. This means if the parents have a high deductible health plan that covers the family and qualifies them for an HSA, the child under age 26 is also eligible for their own HSA and they can make contributions. The only other rule they need to meet is that they cannot be a dependent on the parent's tax return. So if they are a little bit older, say maybe between 20 and 26, and they're making a decent income, they might be filing their own tax return, and therefore they won't be a dependent on their parent's tax return. And the crazy thing is that if they meet these requirements, they can actually fund their own HSA up to the family maximum in any given year, as long as the parent has the family high deductible plan. Even if you and your spouse are contributing the family maximum, the child can still contribute the family maximum. So you essentially can double up. It's a super cool strategy. Now, you might be wondering what 20-year-old or 24-year-old is going to put away $8,000 into an HSA. You might be thinking, my kids spend every dollar they can get their hot little hands on. Well, it's actually very realistic in many cases. The best cases are when they are obviously earning a high income at an early age. This could be because they are a professional athlete, or even some college athletes recently are getting paid. Maybe they entered into showbiz at an early age, or maybe they just have their you-know-what together and started a business early or got a high-paying job after just 4 years of college. In fact, if you as the parent or a small business owner, you could be employing your kids to work in your business, which in and of itself has incredible tax benefits. So they could also potentially fund an HSA with some of the money you pay them. There's just tons of ways you could go about this and save more and more in taxes. Regardless, there are many scenarios where they could be making a great income before age 26 and therefore filing their own tax return and aren't a dependent on the parent's return or anybody else. An HSA could quite easily be one of the first super cool write-offs that they ever take in their life. Very cool stuff. Now it's your job to teach them. Lastly, before I get into our awesome listener question, I want to briefly go over the 3 main strategies or methods someone might use with an HSA as part of their financial plan and their goals. And the first is what I call a pay-as-you-go strategy. This is where you contribute only the dollar amounts that you think you would need for out-of-pocket medical expenses in any given year. Each time a medical expense comes up, you pay for it either directly with your HSA funds. So to do that, some HSA providers will actually give you like a debit card tied to the account, or you pay with your bank account, then you reimburse yourself immediately for that exact amount. Using this method, you essentially are deducting a large chunk of your medical expenses on your taxes in an indirect way. This is because you get a deduction for the money you contribute to the HSA. Then you're taking it back out tax-free. Doing it this way, you likely won't be taking advantage of investing the money inside, and it would likely stay in cash since you plan on spending it. Therefore, you really aren't getting all of the other HSA benefits that we've discussed. The second method is what I would call the hybrid method. This is where you would contribute more than your estimated out-of-pocket medical expenses each year to try and build another bucket of savings to work alongside your other wealth-building assets, whether that be other retirement accounts, real estate, whatever. You keep enough cash in the HSA to pay for any potential medical expenses, and you invest the rest for future growth potential. The third strategy or method would be to take advantage of all the HSA has to offer. You could call this the let it ride strategy. In this scenario, you would max out or attempt to max out your HSA every year, and anytime you incur a medical expense, you would pay for it out of pocket from your emergency fund or bank account. You would also invest all of the dollars in your HSA. This gives you the tax deductions today, the most potential for long-term tax-deferred growth, and the ability to take money out later tax-free by reimbursing yourself at some point in the future for all of the medical expenses you incurred out of pocket along the way. Again, if you use this strategy, you will want to keep clean and meticulous records of all of your healthcare spending, your HSA statements, and previous tax returns for years to come. You can simply keep files of every year, or medical files or HSA files, or you can keep them on the cloud or on your computer. Just make sure you're consistent and make sure you have those accurate records and they're in a safe place, somewhere where you're not going to lose them. That's all I've got for strategy. So now I think it's time for our listener question. I've been keeping this one under wraps for a while now because I wanted to make sure to address it along with all things HSA. This question comes from Diane. Diane asks, what if I have an HSA and my spouse becomes eligible for Medicare this year because he will be turning 65? Do we have to stop contributing to the HSA? I read that we are not allowed to once on Medicare. Thank you, Diane, for the question. This is a good one. It's actually very common, and it's quite hard to find a definitive answer on this for most because there's so much conflicting information out there. But I think I've got you covered here. First, I want to clarify something for everyone. Being entitled to Medicare is not the same as being enrolled in Medicare. Just because someone is Medicare eligible at age 65 doesn't mean they necessarily have to sign up. They might still be employed, let's say, and have an employer's high deductible health plan. And as long as that employer has over 20 employees, they can continue to work and put off signing up for Medicare until they leave the employer one day and they're over 65 and they're no longer covered by that employer's health plan. In this case, you can still continue contributing to an HSA past age 65, which is when you're Medicare eligible. You cannot, however, contribute to an HSA once you are actually enrolled in Medicare. We talked about that a little bit earlier. You also need to be very careful here because if you continue to work past age 65, let's say, and you happen to also begin claiming Social Security benefits, this will automatically enroll you in Part A once you turn 65. So let's say you're working and you're 63 and you say, I'm taking Social Security early. I wouldn't recommend doing that while you're working, but people do it all the time. Once you take Social Security, you're kind of in their system. And once you turn 65, they're automatically going to sign you up for Medicare Part A. And in that case, you would be enrolled and then you would no longer be eligible for the HSA. It sounds like in Diane's situation that her spouse will be on Medicare and she will continue to work and be covered by potentially a family high deductible plan. I'm making an assumption here because I don't have enough facts, Diane. Sorry. If this, in fact, is the case, Diane can still contribute even up to the family maximum, as long as her spouse is still covered under that family high deductible plan, even if they have Medicare. However, if she now has an individual high deductible health plan through her employer, then she can only contribute up to the individual limit. Also, remember that if Diane is over age 55, she can only contribute the extra $1,000 catch-up contribution for herself. Her spouse won't be able to make that portion of the contribution going forward, since that would require the spouse to have their own HSA like we discussed earlier, which they technically cannot or are no longer eligible to contribute to if they did have their own, because they will be on Medicare. Again, in this situation, Diane is the one with the HSA and the high deductible plan. If Diane is in fact changed over to an individual high deductible health plan, she will have to prorate her HSA contributions for her spouse. This will depend on when her spouse actually begins Medicare during the year and the amount of months that the spouse was covered by the high deductible health plan. One last thing, Diane, that I want you to know, as well as everyone else listening, there is yet another caveat for those working and contributing to an HSA past age 65. This is what is known as the 6-month rule, which applies whenever a person signs up for Medicare Part A sometime after turning 65. So this might be you one day, Diane. In these cases, an individual's Medicare Part A coverage begins the later of one of two dates, either the month they turn 65 or 6 months before the date they apply for Medicare. That being said, for someone who chooses to work well past age 65 and plans to switch to Medicare upon their eventual retirement, their Medicare Part A coverage would actually start 6 months before their retirement date, and therefore their eligibility to contribute to an HSA would also end 6 months before their retirement date. So in this case, you would need to prorate your individual contributions in the year you retire and jump on Medicare if you're past age 65. So hopefully that answers your question and more, Diane. I do my best. Thank you all for sending in your questions. And if you have a question you want answered, you can use the link in the episode show notes to email it in or voice record it straight from your mobile device. You can find a link to do so also in the episode show notes on your device. So that's a wrap for today's episode. Don't forget to sign up for the Retired-ish newsletter to get your free retirement planning quick guides for 2024. This is useful and easy to digest information on retirement planning, investments, taxes, estate planning, you name it, once a month, straight to your inbox, no spam. If you find this information and the strategies I provide on this show actionable and insightful, please do yourself a favor and subscribe to or follow the show on your podcast app and share it with a friend who you think might benefit. They don't teach you about HSAs, wealth building, and saving taxes in school. So the more you, your friends, and family know, the better off everyone will be. Of course, if you want to learn more about the topics I went over in today's show, you can find links to the resources we have provided in the show notes right there on your podcast app, or you can visit us at retiredishpodcast.com/45. Thanks again for tuning in and following along. See you next time on Retired-ish.
Strategies to use, yeah. I'm gonna show you how to do this. Investing in tax, estate tips you needed. I'm gonna give you my help. I'm gonna give you my help. Oh.
Securities and advisory services are offered through LPL Financial, a registered investment advisor, member FINRA, SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Past performance is not a guarantee of future results. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise, and bonds are subject to availability and change in price. Government bonds and treasury bills are guaranteed by the U.S. government as to the timely payment of principal and interest and, if held to maturity, offer a fixed rate of return and fixed principal value. Treasury inflation-protected securities, or TIPS, are subject to market risk and significant interest rate risk, as their longer duration makes them more sensitive to price declines associated with higher interest rates. Municipal bonds are subject to availability and change in price. They are subject to market and interest rate risk if sold prior to maturity. Interest income may be subject to the alternative minimum tax. Municipal bonds are federally tax-free, but other state and local taxes may apply. If sold prior to maturity, capital gain tax could apply. Neither LPL Financial nor its registered representatives offer tax or legal advice. Always consult a qualified tax advisor for information as to how taxes may affect your particular situation. Asset allocation does not ensure a profit or protect against a loss. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. This information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax advisor.